Is the party almost over for Australia's low interest rates? After one of the strongest 12-month cycles in living memory, and in the midst of growing fears about inflation, there is mounting pressure on the Reserve Bank to confirm whether interest rates will rise before their mandated 2024 date. Regardless of the actions of the RBA, Australia's big four banks are making moves, adjusting both variable and fixed rates accordingly. Joining us to understand more is senior economist at ANZ Research, Felicity Emmett. Thanks for joining us, Felicity.
My pleasure. Thanks for having me.
So what is the ANZ Bank's view on when the RBA is likely to increase interest rates?
Look, we think that they will probably start to increase the cash rate in around mid-2023, so probably at the May meeting. Now, that's a little bit earlier than what they currently expect at the moment. They've sort of, while they have changed their language and certainly changed the risks around what happens with the cash rate, at their own forecasts are consistent with the cash rate in 2024. So we think that inflation will pick up just a little bit more quickly and wages will pick up more quickly, and that will be enough to sort of meet the criteria that the RBA has very clearly laid out, that they need inflation to be sustainably around the midpoint of the inflation target band of 2 to 3%. And for that to happen, they need wages growth above 3%. So we think those conditions will be met by about early 2023. So the RBA can start hiking interest rates around mid-2023.
So to what extent then, with house prices rising and generally pretty buoyant activity out there, to what extent then does the ANZ Bank think that there is a need for intervention either by the RBA or by APRA to slow house price growth?
Look, the RBA has been very clear that it doesn't think interest rates are the appropriate tool to slow house prices. I mean, house prices really is not in the RBA's mandate. Neither is it for APRA, the regulator. But what the RBA and APRA and others on the Council of Financial Regulators do care about is the growth that we've seen in housing credit, and the fact that that very strong growth has actually come at a time when income growth has been quite weak. And so what the regulators are concerned about is that people are perhaps getting themselves too indebted in an aggregate sense, but also they are concerned about this rise in the share of high debt to income loans, and that is a little bit of a concern to them. So APRA chose to increase the serviceability buffer, and that is probably a more appropriate tool at the moment to try to slow credit growth than interest rates. I mean, Phil Lowe was quite clear last week, as he has been over the past few months, saying that if they raised interest rates to address the heat in the housing market, that would mean that growth would be slower, unemployment would be higher, and wages growth slower. So that would be less likely to meet their objective of getting inflation back into that target band.
Now, we've seen fixed mortgage rates pick up and some variable rates come down. Can you explain for our audience sort of what's happening there and sort of what is driving that?
Yeah, no, there is a lot going on in with mortgage rates at the moment. Traditionally, most Australians would go into a variable rate mortgage until prior to the pandemic. That sort of about 85% of new borrowers took on a variable rate mortgage. And those variable rates are generally tied to the RBA cash rate. Sometimes there can be differences. We saw after the global financial crisis, when funding costs for banks rose quite substantially, we saw a little bit of a disconnect, and the margin between variable mortgage rates and the cash rate widened. But generally speaking, we can sort of use the cash rate as a guide. For fixed rates, it's a bit different. So for fixed mortgages, the banks normally price off market rates. So they try to match the term of their asset and liability, and that for a 3-year fixed mortgage rate, that would be priced closely to a 3-year bond or swap rate. And so what we've seen over recent weeks especially is a really sharp lift in those bond and swap rates as markets start to get concerned that some of the inflationary pressures that we've seen, particularly in the US, but also in other countries, that might prompt inflation in Australia to pick up much earlier than the RBA is expecting and prompt much earlier rate hikes from the RBA. And so those market interest rates are already flowing through into fixed mortgage rates. We've seen them come up. A number of banks increase fixed mortgage rates, and I expect over the next couple of months we'll see further quite significant increases in fixed mortgage rates. Now, at the same time, competitive pressures, rather than any change in the cash rate, has seen variable rates come down a little bit. But overall, what we are seeing in the housing market is those very cheap sub 2% mortgage rates that have been around for the last year or so are not likely to be around for much longer.
Now, we've observed that about half of new borrowers have been opting to fix their home loans just recently. Is the ANZ concerned about serviceability in, say, 2 or 3 years' time when reality bites and those fixed mortgages go into variable rates?
Look, there is a refinancing issue there when there are so many people that have now chosen to go into these fixed mortgages. So many of those mortgages will actually start to come off in the middle of next year. But we're not really too concerned about that. I mean, it will mean that there is those people that are rolling off those very low interest rates and rolling on to something a bit higher. They will have higher repayments. They'll have slightly lower discretionary income to spend on discretionary spending. But when banks determine how much people can borrow, they have been using a serviceability buffer of 2.5 basis points until recently. Now that's lifted to 2.5 percentage points. Now that's lifted to 3 percentage points. And so, new borrowers should be able to afford quite a significant rise in interest rates over the next couple of years. It will impact their cash flow and their spending, but they should be able to afford it. And also, I think we need to keep in mind that actually people have generally very high savings. Since the pandemic, we've seen deposits increase, offset accounts increase. So many households have these very large liquidity buffers. So I don't think at an aggregate level we need to be too worried about how borrowers can tolerate an increase in the mortgage rate. There will, though, be some people who have overextended themselves or are facing changed circumstances. So there probably will be some people who really struggle with those higher rates.
New construction and infrastructure is expected to ramp up next year as the economy opens up further. With supply chain issues already biting and wages starting to increase, what's the forecast for inflation and its impact on the broader economy over the next couple of years?
Look, I think inflation will be relatively slow to pick up. We are seeing these supply chain disruptions sort of come head to head with some of these increases in demand. You see it, as you say, in the construction sector, where we've seen big increases in prices for steel and lumber flowing through. But, lots of those pressures are likely to be fairly temporary. How temporary is the big question at the moment, and whether they last for a quarter or two or whether they last for a year, I think is the big question at the moment, and how they flow through to other price pressures. So We're not really seeing too much evidence of wage pressures in Australia, and that we really do need to see wage pressure before we see that sustained lift in inflation. And I think it probably won't be till the end of 2022 or early 2023 before we see that wage pressure come through. You know, if you look back the past decade or so, wage growth in Australia has faced a number of structural forces, has been very low, and real wage growth has been close to zero. So there is a real focus by businesses on costs, and there is a reluctance to pass on permanent wage increases. And so that needs to be reduced a bit to get those wage increases. So I think it's probably not for another year before we start to see a material increase in wages growth and that lift of inflation into around that 2.5% level. So I don't think that we're likely to see the sorts of pressures that we are seeing in the US at the moment, where there has been a lot more of those supply constraints passing through to inflation, and there is different labour market dynamics that have seen wages lift more quickly than they're likely to here in Australia.
And just finally, Felicity, are you fixing your home loan or are you sticking with variable?
That's a tricky one, isn't it? No, I'm not fixed. Perhaps that's a mistake I've made. Economists are always very risk averse, but no, I am not fixed. But fingers crossed.
It's always good talking, Felicity. Thanks for your time.
All right. Thanks very much, Adam.